Hey there, future Wall Street Titans. Welcome to the Thunderdome, where the stakes are high and the rewards can be even higher. If you've ever dreamed of making it big in the world of finance, you're in the right place. Today, we're diving deep into the heart of the stock market, where fortunes are made and lost in the blink of an eye. We're here to break down the name of the game in investing, the risk-return trade-off. It's a concept that's as old as the market itself, but it's crucial to understand if you want to succeed. The risk-return trade-off is all about balancing the potential for profit with the potential for loss. It's the tightrope walk that every investor must master. Think of it like this: higher risk, higher reward. Imagine you're on a roller coaster. The higher the climb, the more thrilling the drop. But with that thrill comes the risk of a stomach-churning fall. In the stock market, taking on higher risk can lead to greater rewards, but it also means you could lose more if things don't go your way. Lower risk, well, you get the picture. It's like driving in slow-moving traffic. It's safe, predictable, and you know you'll get to your destination eventually. But it lacks the excitement and potential for big gains. Low-risk investments like savings accounts or government bonds offer stability but usually come with lower returns. It's a wild ride. You'll be riding the bull, not getting trampled by it. The stock market can be unpredictable, but with the right strategies and a bit of courage, you can navigate its ups and downs. Remember, it's not just about taking risks, but about taking smart risks. This ain't your grandma's knitting circle, folks. The stock market is a fast-paced, high-stakes environment where only the savvy survive. It's like a competitive sports game where every move counts and the pressure is always on. But that's what makes it so exciting. This is the stock market where fortunes are made and lost every single day. One moment, you're on top of the world, and the next, you're scrambling to recover. It's a place of constant change, where every decision can have significant consequences. But that's also what makes it a place of endless opportunities. But don't let that scare you off, because with a little bit of knowledge and a whole lot of guts, you too can come out on top. The key is to stay informed, stay focused, and never stop learning. With determination and the right mindset, you can turn the stock market into your own personal Thunderdome where you emerge victorious. Here's the deal: the more risk you're willing to take, the higher your potential return. Sounds simple, right? Well, it is. Think of it like a roller coaster. The higher you climb, the steeper the drop, but oh man, what a rush. But hold your horses, cowboy. Before you go throwing all your hard-earned cash at the next hot stock tip, remember this: risk works both ways. You could make a killing, sure, but you could also lose your shirt. That's why it's called a trade-off. Now let's talk about the different types of risk you need to wrap your head around. First up, we got market risk, which is basically the chance that the entire market takes a nosedive. Think of it like a bad hair day, but for the stock market. Then we got inflation risk, which is when your money loses value over time because everything's getting more expensive. Like when that $5 footlong from Subway suddenly becomes $10. Inflation. Alright, let's break down some investment options, from the sleep easy at night to the hold on to your hats kind of stuff. On the low-risk side, we got your good old-fashioned savings accounts and government bonds. These are about as exciting as watching paint dry, but hey, at least you know your money's safe, mostly. Then we move up the ladder to real estate and corporate bonds. A bit riskier, but with the potential for some decent returns. And finally, at the top of the mountain, we got stocks, baby. High risk, high reward. This is where the real action is. Section 5. Finding your risk sweet spot. It's personal. People. When it comes to investing, there's no one-size-fits-all approach. Each person's financial journey is unique, and so is their tolerance for risk. Understanding your own risk sweet spot is crucial for making informed investment decisions that align with your personal goals and comfort level. Now, the million-dollar question, literally, how much risk should you be taking? This isn't just about numbers and charts, it's about understanding yourself and your financial aspirations. Are you someone who can handle the ups and downs of the market without losing sleep? Or do you prefer a more stable, predictable path? Well, that depends on a bunch of factors: your age, your financial goals, your risk tolerance, and your investment horizon. Younger investors might have the luxury of time to recover from market downturns, while those closer to retirement might prioritize preserving their capital. Your financial goals, whether it's buying a house, funding education, or planning for retirement, will also influence your risk tolerance. Risk tolerance is basically how much of a gambler you are. Some people thrive on the thrill of high-risk investments, while others prefer to play it safe. It's important to be honest with yourself about your comfort level with risk. If the thought of losing money keeps you up at night, you might want to consider more conservative investment options. And whether you prefer boxers or briefs, just kidding. But seriously, understanding your personal preferences and comfort levels is key to finding your risk sweet spot. It's not just about the numbers, it's about how you feel about those numbers. Just kidding about that last one. Or am I? The point is, investing should be a balance of logic and emotion. You need to be comfortable with your decisions and confident in your strategy. A good laugh and a light-hearted approach can sometimes help ease the stress of financial planning. The key is to find the right balance between risk and return that lets you sleep at night. This balance is different for everyone, and it might take some time to figure out what works best for you. Consulting with a financial advisor can provide valuable insights and help you navigate the complexities of investing. Don't be afraid to start small and gradually increase your risk as you get more comfortable. Investing is a journey, not a sprint. Starting with smaller investments allows you to learn and adapt without taking on too much risk too soon. As you gain experience and confidence, you can adjust your strategy to take on more risk if it aligns with your goals. Remember, Rome wasn't built in a day, and neither is a killer investment portfolio. Building a strong, diversified portfolio takes time, patience, and careful planning. Don't rush the process. Take the time to research, seek advice, and make informed decisions. A well-thought-out investment strategy can lead to financial success and peace of mind. Celebrate your milestones, no matter how small, and keep learning and adapting. Your financial journey is personal, and finding your risk sweet spot is a crucial step towards achieving your goals. Section 6. Time, the investor's secret weapon. No, really. Here's a little secret that separates the amateurs from the pros. Time is your best friend when it comes to investing. The longer you're invested, the more time your money has to grow, and the less impact short-term market swings will have on your overall returns. Think of it like this. Planting a tree. The best time to plant a tree was 20 years ago. The second best time is today. So, stop procrastinating and start investing now, even if it's just a little bit. Your future self will thank you. Section 7. Boo-boos to avoid. Don't be a rookie. Alright, time for a little tough love. Here are some common mistakes that newbie investors make and that you should avoid like the plague. Putting all your eggs in one basket. Diversification is key, folks. Trying to time the market. Don't even try it. Even the pros can't do it consistently. Panic selling. When the market takes a dive, don't freak out and sell everything. Ride it out, and you'll come out stronger on the other side. Section 8. Taming the Beast Strategies for Risk-Return Harmony. So, how do you actually manage this whole risk-return thing? It's a question that every investor grapples with, whether you're a seasoned professional or just starting out. The balance between risk and return is crucial, because it determines the potential for growth in your investments, while also considering the possibility of losses. Here are a few strategies to get you started. These strategies are designed to help you navigate the complexities of the financial markets and make informed decisions that align with your investment goals. Dollar cost averaging. Invest a fixed amount of money at regular intervals regardless of market conditions. This method involves consistently investing a set amount of money into your chosen investments, whether the market is up or down. This helps to reduce the impact of market volatility. By spreading out your investments over time, you can avoid the pitfalls of trying to time the market and instead benefit from the long-term growth potential of your investments. Rebalancing. Regularly adjust your portfolio to maintain your desired asset allocation. Over time, the value of your investments will change, which can cause your portfolio to become unbalanced. This helps to ensure that you're not taking on too much or too little risk. By periodically reviewing and adjusting your portfolio, you can make sure that your investments remain aligned with your risk tolerance and financial goals. Don't be afraid to ask for help. If you're feeling lost, don't be afraid to consult with a financial advisor. Financial advisors are professionals who can provide valuable insights and guidance based on their expertise and experience. They can help you create a personalized investment plan that meets your specific needs and goals. Whether you need help with selecting investments, planning for retirement, or managing risk, a financial advisor can be a valuable resource in your investment journey. Additionally, staying educated and informed about the financial markets is crucial. Attend seminars, read books, and follow reputable financial news sources to keep yourself updated. The more you know, the better equipped you'll be to make sound investment decisions. Setting clear financial goals is another important strategy. Knowing what you want to achieve with your investments can help you stay focused and motivated. Whether it's saving for a down payment on a house, funding your child's education, or building a retirement nest egg, having specific goals can guide your investment decisions. Regularly reviewing your investment performance is also key. This allows you to assess whether your investments are on track to meet your goals and make any necessary adjustments. Remember, investing is a long-term journey, and staying proactive can help you navigate the ups and downs of the market. By implementing these strategies, you can achieve a harmonious balance between risk and return, paving the way for a more secure and prosperous financial future. Happy investing. Section 9. Go forth and conquer, but smartly. There you have it, folks. The risk-return trade-off in all its glory. It's not rocket science, but it does require some careful consideration and a healthy dose of common sense. Remember, the key is to find the right balance between risk and return for your individual circumstances. So, what are you waiting for? Get out there and start investing. The world is your oyster, and the stock market is your playground. Just remember to play smart, and you'll be well on your way to building the financial future of your